Thanks everyone for joining us today for Seveney Investments, the launch of our Reg A plus offering. This is our second A plus offering that we are looking to provide those monthly distributions backed by real estate. And one of the differences with this offering that we want to share with people over the last several years with our first offering was we're providing different options to investors. And the prior offering, we had the bonus shares, which some people thought a little bit confusing. So in this offering, we wanted to provide a short-term, medium-term, and long-term option for investors. I wanted to start off with this. We're going to get to this at the end, but I wanted to just give people the highlights that this current Regulation A plus offering is looking to provide between 7 and 10%, depending on the investment amount and the year that is selected. So with that, though, I want to start off again with who we are and what it is we do. And throughout this presentation, we're going to cover what we do in detail, which is buying and selling performing and non-performing mortgage notes secured by those single-family homes with the goal of producing those returns for our investors. And as we go into more detail, you'll see all our strategies and how that is outlined. But what I really want to focus on these early slides is what I think matters most to you as someone considering investing with us, which is who we are and how we see this opportunity when a lot of others may not see what we see. Now, the mortgage market has hundreds of billions of dollars on non-performing loans. And honestly, yet for years, it's been treated more like a bulk commodity where investors buy pools, hand it to a third-party servicer, and manage it from a spreadsheet. You know, I call it top-down management. For us, we look at it differently. We saw that structural inefficiency. We see every loan in a pool is very different. It's different property, different borrower, different state law, and a different path to resolution. When you manage from the top down, a lot of times that gets missed and potentially could leave money on the table. What we built is a bottom-up strategy where we evaluate every single loan individually. We look at the asset, the borrower, equity position, what we do in our due diligence, and also where is that property located. And we don't outsource that judgment. We have that in-house and we engineer that outcome. And for us, that's what we think is a differentiator between us and a manager who builds a platform to manage this versus somebody who looks more on hopes for performance. So how did I get here? Because my path into the space is probably not what people would expect. I'm an engineer by training. I spent over 2 decades of my career in real estate and construction. And during that time, I was managing some large complex projects, but those experiences shaped everything about how we run Seveney today. At Suffolk Construction, I oversaw over $750 million in construction. And when you're dealing with things at that scale, there's an instinct for where and when things may break down. You've got cost overruns, time slippage, execution failures. You learn to identify risk early, price it, and build in mitigation into plans and problems before they arrive. And honestly, that's not a skill I could learn in a classroom. You learn it by having to work in every single project. Then when I was with EYA, it was a different challenge. They were launching a new multifamily division from scratch. And that was an experience where I learned to build systems and teams around standards and repeatable processes. It's not just how to do one deal well, but how to do it consistently and at scale. And then at Tower, I was their director of construction and development, and they had a $2 billion portfolio it's a DC family office. And that's where I saw firsthand what true institutional asset management looks like from the inside, how sophisticated capital owners think about risk, transparency, reporting, and that long-term performance accountability. And all 3 of these experiences live directly inside how we run Seveney. So that corporate background gave me the foundation, but there were a few defining moments that took me from that real estate side to building Seveney specifically. When I entered the space 10 years ago, Again, I mentioned I had that 2 decades of working for other organizations, and I saw this market was ripe for a very different approach. So I started buying assets and one at a time, and then the 6 full cycle funds. And each one operated through different types of assets, different market cycles, the breadth of experience across those cycles, the states, the borrower profiles. Again, something that you get with experience and you can't shortcut. But along the way, what I realized and bothered me a little bit was this asset class was almost entirely limited to institutions, hedge funds, and the big players. Individual non-accredited investors had no real path to get into this type of investment. And even those who were accredited still had significant hurdles in some of those investments to get into. And also, we saw a lot of lack of transparency. And really, that gap is why Seveney exists. We built the platform, infrastructure, and the track record to keep this asset class open to a broader investor base. And we also don't sacrifice rigor and discipline that allows us to get this work done. So that's why I wanted to share our backstory, who we are, how we do it. And along with that, kind of rolls into our mission, which is expanding access to these opportunities while seeking solutions that support both investors and these homeowners. As I mentioned about our experience, we have managed over 750 deals, over 100 million in valuations. We've invested in over 40 states. Seveney has been around for 10 years. We've got those prior funds. As I mentioned, we've seen those different market cycles from pre-COVID to COVID. Now, I'll call it, we're in this post-COVID phase. And throughout every one of those offerings, there's never missed a distribution to our investors. Now I'll dive more into what we do and more about the note investing space and buying these non-performing and performing loans. First, let's peel back for a second and let's get an understanding. What is mortgage note investing? And I'll start with this is if anyone's ever bought a house and you get a loan on it, you sign the documents, about 3 to 4 months later, you might get a letter in the mail that says, please make your payments to XYZ company. When you get those letters, it's usually a transfer because your loan has been sold. Most people don't realize the amount or percentage of loans that get sold on the secondary market. And that's a great example we share. But really what it boils down to, mortgage note investing is investing in a loan secured by the real estate. We buy loans from lenders, banks, credit unions, institutional investors, and we'll target to buy those at a discount where then we step in as the lender. We don't own the property. Remind people, we don't own the property. We're just the lender. I'll use Wells Fargo as an example, just as an example, to collect those payments. And as the owner of that note, we have the rights to all those future payments. A lot of people ask, Chris, I've never heard of this. Sounds great, but is there a lot of supply? Is there big demand for this industry? We remind people the mortgage market, it's a $14 trillion industry, and that's on residential mortgage debt with over 50 million properties in this country that have first position mortgages on that. Now, if you reverse engineer the numbers, that's about $400 billion in non-performing debt and about 1.5 million homes in default. And if we look at our portfolio right now, which is 100 plus loans or assets in our portfolio, and even if we got the 250 or 500, we're still a fraction of a percentage of a market share that we're looking to target or get into. So there's ample opportunity in this space. With that opportunity, people ask, why is there this opportunity? There's always distress in the markets. And what is a leader for what causes distressed debt? People don't typically wake up one morning, say, I'm going to go to the gym, work out, and then make sure I don't pay my mortgage. Typically, it's because, unfortunately, a job loss, health condition, divorce, as today more dual income families are getting mortgages, I think, more than ever. And if There's separation. Typically, it's unaffordable for one to afford that property, and then death. These are typically the four common reasons. And in three out of the four, we can typically work out an arrangement still with those borrowers, with, of course, death being the one that cannot work something out with. Now, the other component or question we get asked a lot is, when people are selling these loans, are they selling bad loans, meaning there's problems with them or issues, and there's a reason why they are selling them? And the answer is no, in most instances. Banks and lenders want to get them off their books for many reasons. One is they're not staffed to manage a non-performing asset and the impacts. I had a call last night with someone we buy a lot of loans from, and they were talking about an institution that we bought loans from in the past, and they've got another large portfolio of assets they're selling. And the simple reason is they have nobody on their team that can manage assets, especially non-performing. So they want to get them off their books because they prefer the performing loans. And that by selling those, it gives them the ability to lend more. And the other reason is, let's take several years ago when people were able to refinance at 3, 4, 5%. If that loan goes non-performing and you're a lender, would you rather have a $250,000 loan at 4% non-performing, or get paid that money and go write a loan today for $250,000 at 6%? Of course, they'd rather have that new loan. Also sell because they want to rebalance their portfolios, a fund may be closing, or it doesn't fit their buy box. We buy assets, and right now we're in about 20 states. As I mentioned, we've been in 40 before, where I use Montana as an example. The servicer we use does not service loans in Montana. We had a pool that had an asset in Montana. So we turned around, and after we bought that, immediately sold it to an investor, because we didn't want to have to set up a whole new contract and servicing with a third-party vendor just for that one asset. It didn't make sense. People have very specific buy boxes, and if they're buying sometimes pools, they might have to take the whole pool, and it's another reason why they may sell an asset. You'll typically hear the phrases performing and non-performing. I just want to take a minute and define what that means. Performing is the borrowers making their payments. They're meeting their obligations. Now, when we go to buy those, we typically can purchase them at a slight discount, or we've also originated some short-term loans to investors, and collecting that interest and getting that cash flow. Now, non-performing is the term that people really sometimes get clarity on the definition, because borrowers fail to meet their repayment obligations and the loan is in default. Now, a lot of loans that we see and look to purchase are year to years in default, not one or two missed payments. Many of them are years behind. I think the longest we've had is a borrower that was approximately 10 to 11 years behind is the record that we've seen. But it's not 30 days, somebody's knocking on their door, threatening them like you might have seen on a movie and so forth. These loans have some serious default delinquencies to them. No's typically will sell at a greater discount. The longer they're behind or in default, typically the greater discount. And this is where we step in. Our team looks to work one-on-one with our servicer, through our servicer to the borrower, to what we will call is fix and flip the loan, which is a term you'll hear us throughout, which is, if you think of fix and flipping a property where you buy it, rehab it, and resell it, we're doing that with the buyer. We buy it, we rehab the borrower to try and get them payments to get a desired outcome that increased the value, which leads to our core strategy, which is we have two paths, what we like to say, one through the borrower and one through the property, where we buy or originate these loans on single family homes. And if it's non-performing, we'll start trying to negotiate payments with the borrower to generate that cash flow. And then we have a myriad of exit strategies that we'll talk about on a future slide. And in some instances, we may take ownership of the home. And then once we take ownership of the home, we now control that property and determine we sell it. What do we do with that? So we always start with the top, which is trying to exit through the borrower. And if that is not successful, then we go down that second path. But what's interesting about these exit strategies is 5 of the 6 that I have listed up here on this slide are working with the borrower on a positive resolution, which is we get them reperforming and we sell that loan on the secondary market. We allow them to pay off the loan with a potential short payoff, which may occur for expediting getting us payment or based on the property value. The borrower may refinance that loan. The borrower may give us a deed in lieu, which is they just hand us the deed to the property because they don't want to deal with it, which is much advantageous to us than a foreclosure. The property may sell, whether the borrower sells a property, which is something we're seeing a lot more frequently right now, of people cashing in that equity to pay off their credit cards and other debts. Or if we take it back, we could sell that property, keep it as a rental. And then that last option is a foreclosure, which is typically that last resort, which is when we can't work something out with the borrower on any of these other strategies. Now, when we're looking at these non-performing loans, one of the areas that we spend a lot of time and focus on is the investment to value. And this is preferred by us because one of the risks in note investing is what's the value of that property? Because we cannot go inside. Your lender knocks on your door. You're not going to let them in your property. No different. We don't have access to the inside. We might see pictures online, people posting holiday photos on Facebook, whatever the case may be, but we don't have a good exact number. We have a good idea. We have a very good idea of what that property value is, but not to the exact. So we target loans that have a loan to value and investment value that what we view as conservative. So on a $250,000 property, we'll target a loan that might be $200,000. And then when we buy that note at a discount, if we pay $120,000, $150,000, whatever we're paying for that loan, understand that at $150,000 even, you're at a 60% investment to value, meaning the price of that property will have to be 40% less to then have any type of impact on the investment. So that's the number we target, around that 50% investment to value number when we're going after these assets. Now, we briefly talked about deal flow and the size of the market. And just this last quarter, or actually I haven't finished a quarter yet, we've seen close to $6 billion, and that's typically what we see in our opportunity. But that's a really big number. How does that boil down into something of substance? Of the $2 billion we received, we looked at about $700 million of loans. Okay, and this is all non-performing. So we looked at about $700 million in non-performing loans with a target to close basically on about 2% of those bid. So of the 700 million, we got about $14 million under agreement. And that is based off of us and how we analyze all of these through our due diligence up front and then later on, which is really looking at it from an asset by asset basis. And when we do our due diligence, we start with the 3 Ps: the property, the person, the predicament. And the property, we look at the actual condition of the property. We send somebody out there, multiple people out there, to take photos of the property, get us an idea what the condition is, and a value assessment of, based on its as-is condition, what that property is worth. And of course, we always discount that number within our models to alleviate, control some of that risk. And then also the title report will tell us, is this a first position mortgage? Is it a second position mortgage? We've had loans that people thought were first and they were in a third position. Then we look at the person themselves. We what's called run a skip trace, where we look at their criminal history, financial history. How many times did they file bankruptcy? Have they ever? Or have they filed 5 times? If a borrower has never filed bankruptcy and one has filed 5 times, which one is more likely, you think, to probably file bankruptcy? Most likely the one who's filed 5 times. And also, we also get a log or a history of all the conversations and emails that the servicer has gone through with that borrower and seeing what it is they want to do. And we've have deals where we've gone out and looked at those notes and the borrower's begging the lender, I'll give you $5,000 and I'll start making payments again, but I can't reinstate the full 20. And the lender does nothing. We buy the loan, take the 5 grand, adjust it, and let them keep making payments and go on our way. And lastly, again, is that predicament. The 4 items of death, divorce, job loss, situational. And in those situations, we'll look at what was a cause and is it something we think we can rectify and remediate. If it's not, we won't buy the loan. And one of the biggest components of due diligence is legal and having attorneys review our collateral, which is all the documents, and having an attorney in every state. We have multiple attorneys in every state that review this because a note and a mortgage are actually 2 different things. The note is the IOU, which says you're going to pay this much. And the mortgage is the document that gets recorded in the county that says if you don't pay the note, here's what you can do and go after. And if you lose the note, it's like winning the lottery and signing the back of the ticket, but losing the ticket. You can be in a lot of trouble. Go to the lottery commission to cash that in. You're going to say, I had it, but I don't have it anymore. Same thing if you go to a court and say, I used to have this note, I don't have it anymore. Certain states, that can be very problematic. The mortgage is if you have the note and they stop paying, you want to be able to possibly foreclose on that property. But what if the mortgage listed the wrong property? We've seen it. We've seen documents out of order. We've seen them recorded in the wrong county in Louisiana, which I think has parishes. I had a mortgage that was recorded in the wrong parish. Then bankruptcy. Bankruptcy can get very complex, and that's something that we work with our attorneys on as well to make sure we understand where this case is going. And last but not least is statute of limitations, making sure the loan is still collectible, because there are ways that you think the loan is still good and an attorney reviews it and says, you can't collect this debt anymore. So definitely very thorough due diligence processes we go through on every single note. Same process on every single note. It's rinse and repeat every single time. So we talked about Seveney, our strategy, a little bit about mortgage note investing. Now let's talk about a mortgage note fund and why you should consider a mortgage note fund. First, you've got that passive cash flow without the headache of managing an asset. For example, I know a lot of people might do private lending. You have to underwrite the borrower, collect all the documents, work with things, collect the payments, and chase people down for things. Is that something that you want to spend the time doing? For us, we manage the assets to portfolio so you don't have to. We target those monthly distributions, and our team handles all the day-to-day operations. The other is profitability and varying market conditions. And we get asked this question a lot about interest rates and home prices, whether rising or falling. How does that impact? It's very negligible. Defaulted loans are a constant. There's always going to be defaulted borrowers. If you look at historical charts where things fall, today we're actually closer to all-time lows on defaulted loans. And we've had some really good years the last few years, and those are starting to tick up because of interest rates and home prices and other things. But all those do is slightly change the parameters a little bit. But again, defaulted loans are a constant. And we built our strategy around acquiring these notes at a discount, targeting a specific yield. So if interest rates rise or fall, it has very little impact on the performance of our loans because of the yield that we target. The other is the real estate as collateral. Mortgage notes secured by physical real estate. Unlike some other investments, each note is backed by something tangible and real, which serves as that collateral. I'm still trying to figure out what a digital wallet is. And for example, crypto, the only wallet I have is one that I can touch and feel. That's what I like about real estate. You can physically see it and see that investment. And then the versatility and that selective deal sourcing. Before we acquire any asset, I've already gone through all of that due diligence that we go through and really look at those exit strategies, the sourcing, the diversification of what states we want to be in. The entire portfolio gets analyzed on an asset by asset basis, but also as an overall portfolio. Now I want to spend a few minutes also diving into some case studies. As I've talked about what it is we do, what mortgage note investing is, our strategies. Now let's see it in action. Here's a loan in Palm Beach, Florida, that we acquired this loan. It was a performing loan over a very short period of time, and the borrower needed the funds to complete the renovation. This borrower had a very high net worth, excellent credit, and the borrower was in the process of selling their business. So as part of that, they needed the short-term funding to finish this while they were selling their business versus having to go sell or borrow against their stock portfolio. And this borrower had a very low loan to value that we targeted. The loan was about 50% of the property value, and borrower was making their monthly payments. They sold their business, and we got paid off in full. So this is a strategy that we use on the performing side for cash flow within getting cash flow into the fund. Now here's the exact opposite of this last case study. This was a non-performing loan that we acquired, and the borrower was behind, and we engaged legal to send a demand letter. And while it notes the borrower was 4 months behind, the borrower had several modifications prior that brought it current and then got behind. And the lender kept trying to work with them to the point of they could no longer work with because the borrower was in prison and did not want to keep the property. We actually still were working with the borrower while they were in prison to attempt to sell the property, but that came to a head and we ended up having to foreclose. It's one of the rare instances that we had to foreclose and we took the property back. Because this was a very large property in Henderson, had a beautiful view of the Las Vegas Strip, the property in its current condition couldn't be a rental and needed to have some upgrades to it. So we went in, we renovated the property. Again, going back that 20 years of experience that I have, found a local contractor, had a great real estate agent, renovated this property and put in several $100,000 that increased the value of this property by over $500,000. And it allowed us to sell this property to a third party and exit this property. So this is the exact, again, opposite of hands-on asset management, working through the deal from start to finish compared to that first one. And then the third scenario that we see is property where loan was non-performing. In this one, borrower was more than a year behind, bought this at a good discount. And also, again, that loan to value component was about 70%. Initial outreach was unsuccessful when we try to work with the borrower. So we have our attorney send a demand. That is very common that we start the foreclosure process, but rarely finish with it. Borrower became responsive. And the reason typically is they get all the junk mail and just see a letter from Seveney Investments, I don't know, or the servicer, I don't know who this is, but when it says law offices of somebody, people usually will open that piece of mail. In this instance, we got the borrower to sign what's called a trial payment plan, which is before we modify the loan, we want them to prove that they can make these payments. And borrower's making payments, borrower was getting an annual bonus, got the bonus, got everything caught up, but unfortunately fell back behind. But we were able to, through our asset management team being very on this deal, get the borrower back on track to, again, start making payments and reinstate the loan. Got that worked out. And then we end up selling this loan back on the market as a performing loan. And that fix and flip of distressed loan, repair the borrower, get them on payments again. So you increase the value and then sell it in the future. So these were 3 case studies that we want to share from the different paths or different outcomes that we typically will see. So with that, I want to again go back to the new Reg A, what we're calling Reg A Plus 2.0. And as we mentioned, it's open to both accredited and non-accredited investors. We kept that $5,000 minimum like our prior offering. Differences is we have a shorter term, which is up 1 year plus, and there's a 6-month window for redemptions of investing now redeems the end of next June. There's the 4-year option at 5,000, a 4-year option at 50,000, and then a 7-year option that has a $50,000 minimum as well. And we made these adjustments again because we have over 1,000 investors, and we were taking feedback from asking feedback from everybody. What would you like to see as we go to create this example or this fund? And wanted to, again, keep things simple so it's very easy to understand and give people a little bit more flexibility. Now, some of the highlights. Again, accredited and non-accredited. Distributions paid monthly. If you invested today, your first payment would be received on May 1st. Interest would start accruing on April 1st, so we pay in arrears, meaning you get your payment on May 1st. We view this as an uncorrelated asset class. Oil prices right now, I don't even know where they're at today. I know they've gone way up, came back down a little bit, all over the place. The markets, a lot of volatility. Real estate over the last week really hasn't done anything significant, of course. Real estate's a long play, but also in this defaulted debt space, as I mentioned earlier, there's always defaulted debt, and it's pretty consistent of where everything falls or everything falls into line. That 3 times collateral coverage that we talk about in regards to looking at a property at $300,000 and making sure we've got that investment to value and the coverage within our portfolio of managing the entire portfolio for that investor protection / focusing on that aspect of the business. We have 100 plus assets in our current portfolio. And from a tax reporting purposes, you got a 1099, no K1s. Also, no UBIT. We have a lot of self-directed IRA investors. One of the most important things, if you're looking at investing with a self-directed IRA, question you ask every single sponsor, what's going on with UDFIs and UBIT? I want to understand that. And I know some offerings who are LLCs that have leverage, you don't know until you get your 1099 or your K1, excuse me, what it is. Our funds, not something based on today's laws that anybody has to worry about. As I mentioned, that 1 to 7 year term, so giving people that short-term or long-term investment opportunity. For me, I'm the type of person that I prefer set it and forget it long-term, so I don't have to find something new to invest in every year or vice versa. And lastly, that transparency, audited financials. We report to the SEC, audited financials, semi-annual reports. So all of our documentation that we provide regarding that financials gets submitted to the SEC for people to review. I want to highlight, again, the 7 reasons for Seveney I talked about earlier. The leadership, the track record of the company, how we target these risk-adjusted returns by vetting each loan, that bottom-up strategy that we look for in our assets. The 2 that I believe are so important are that in-house asset management and that white glove investor experience. Having our asset management in-house, managing the servicer, but not only the servicer, the attorney. We deal with the attorneys directly. Most of our competitors let the servicer pick the attorney, deal with the attorney. And every time you have another person involved, communication, everything slows down. Speed and time are so essential in this business. Having that direct contact and direct access to those attorneys is invaluable. And then providing our investors that white glove investor experience where you can pick up the phone or email us at invest@Seveney Investments and have Tamara or Leilani or somebody, a member from our team, answer your call. And if they don't know the answer, be able to get you that answer in a very timely fashion. We also, of course, are hands-off investing, where we manage all the aspects of the investment. Diversification. Access to these offerings is, we look at it from a diversification of a portfolio. Also, we are a portfolio of loans. We also are diversified across our investment strategy. We're not all of our loans in one specific state or one specific geography, because market pricing today for real estate is driven a lot by certain market areas that might do better or worse than others. So we, again, diversify within where we're located in roughly 20 different states. And last, the investment mandate. This is what we do. This is all we do. We invest in mortgage notes. You are not going to see a 7E self-storage fund. You're not going to see us in 20 different, dipping our toes in 3, 4, 5 different other asset classes or investments within our portfolio. This is it. We buy notes. And that's what we are continuing to focus on within this offering. So if you're looking to or ready to invest with us, and if you've invested in the past, we've made the investment process very streamlined. We do have a new link with a new platform that you, through North Capital, who is also our escrow company. So it's now one and the same, which actually simplifies everything. But you can log into that platform, review the offering docs, enter the investment info, send the funds, sign a subscription agreement, and you can either ACH, mail a check, wire. Everything can be pretty much, again, done through this platform. And you can get the link at our website, 7einvestments.com. And as I mentioned, Leilani and Tamara are here to assist with any questions. And if you do have questions, you can also email them to us at invest@7einvestments.com. Now, before we head over to the Q&A portion of this call, I just want to start with some of the FAQs. And the first one is, we've had our prior funds, our prior Reg A, which we're not accepting investments in that. But if you were an investor in those funds, you can keep your investment in there. It's not like you have, there's no, not early redeeming. That's still open, but just not accepting new investments. We have this new fund. But also the investment is the same assets. It's the same company under CWS Investments, Inc. So it's not a separate pool of assets. It's the same portfolio of assets. Now, if you're a current investor, can you transfer your investment to this offering? Not at this time. We're evaluating this option for later in the year. But as of today, we're not accepting early redemption transfers into that offering. This offering, how long will it be available? We plan on this offering being open for 3 years or until it fills, whichever is sooner. With the Regulation A+ offering, it's good for 3 years. Every year we do have to renew that offering, but we do not plan on closing anything down early. Where does this fit in the capital stack? Investors in this offering are on equal footing with prior investors, which is known as pari passu. There's not, when you look at the capital stack within our company, and this is, I think, an important thing to ask sponsors as well, is where do you sit in that capital stack? And for us, the investors, we don't have any debt. There's no leverage currently within our fund. So investors are at the base of the capital stack and they're all equal. So if I had to go and turn around and sell every single asset tomorrow, whatever bills we have would get paid, and then the rest would go to the investors. Unlike, I'll use the example of multifamily because that's an easy one that people might be familiar with. They might get 70% leverage from a bank, and then the investors are behind that bank. And if that value drops, then the bank gets their money, but it could leave the investors, unfortunately, out to dry. In our instance, there's nothing there in between. There's no bank currently. The bonds that we're issuing are sold in $1,000 increments, and the bonds are required to be held to maturity, but you don't have to redeem them at maturity. You can continue holding them, and similar to our prior offering, once redemption occurs, you can either redeem or continue with the investment. Now, if you still have questions and you'd like to speak with a team member, here is a QR code that you can scan on your phone and goes to a link where you can book a call with someone from our team. And I'll come back to this in a moment. I do also have to put up our disclaimer that the bonds in this offering, I'm not going to read this disclaimer. I'm going to leave it on the screen for people to quickly read. And then again, with the recordings, and if somebody wants a copy of this, we are also happy to copies. We also have these disclaimers on the website. So I do want to thank you for being on here today. Again, you can email us at invest@Seveney Investments or call us at 866-226-5736. So I appreciate everyone for coming on today. Thank you all for being on today. Greatly appreciate everyone coming on and look forward to hearing from all of you in the future. Take care. Enjoy the rest of your day. Thank you.